What's up guys, welcome back to my channel. Today's video we're talking all about 4 dividend stocks in my portfolio with a cumulative value of almost $50,000 I have into it, and that is generating almost $1,700 a year, $141 a month, $33 a week, and about $5 a day. All this definitely adds up if you are building a long-term portfolio and you want to have some great stocks that you can just sit back and watch and relax, knowing that they are relatively safe. They've got good business models. They're getting some passive income to you. Now, a few things to keep in mind. Number one, you probably aren't going to get rich off of dividends. Some of them have more profits in some years than others. And you can also probably not expect 50% revenue growth or 100% revenue growth in these stocks more often than not. However, you are going to have some good opportunities to buy these stocks at low prices at times and low PE ratios, making them very undervalued. The second thing you want to be concerned about is really vetting those stocks for that consistency. So you want to make sure that you look through the history of the stock chart and look at the history as far as the revenue and net income for this company, and as well as how consistently they pay this dividend to ensure that this is in fact a good dividend stock. You don't want to be caught up in something that pays 10% dividend this year, but the company's fundamentals are doing terribly. They're losing customers left and right. Their income is going down. Eventually, they're going to cut that dividend. They're not going to pay you anymore. And if there's no dividend to draw investors in, that stock is probably going to tank even more. So tied into that is you want to make sure that whatever stock you're invested in, it doesn't have a super high payout ratio. So the payout ratio is what percent of the company's net income are they paying out as dividends? If they're paying out 100% of their profits out of the business, then they're not using any income to grow the business and get more sales and more income. They're just paying everything they got to you, so the business is just going to be stagnant. And over time, they're probably going to lose more business, and it's not going to be a positive thing. So just because something has a high dividend doesn't mean, again, that you want to be investing into it. So the first one we're talking about here is JPM, okay? This is the second largest position overall in my entire stock market portfolio, and sitting here today at around $149, $150 per share. They just reported earnings not too long ago, and it was a huge blowout. They did a lot better than expectations as far as revenue as well as net income. They almost beat by $1 EPS. And that is because they're able to release $5 billion in loan loss reserves that they have built up over the past year in order to weather the pandemic storm. As it turns out, a lot of consumers are doing better than people expected, so they're not going to need to save so much money and write off as a loss. And projections seem to suggest that they will have potentially another $5 billion to bring back onto their balance sheet, which is a big thing. This company already has a very low PE ratio. It's sitting around 11 as of this recording. The market average is well above that. And even for financials, when you look at historically, trading 10 to 15 is pretty reasonable. I think in this environment, it could definitely warrant a PE of 15 when you consider some other tailwinds that will go for the bank's favor in coming years, such as rising interest rates and more trading activity. They have a really thriving trading business when it comes to bonds in particular. So that is going to continue to see some pretty good strength in my opinion. And it allows for the company to be diversified. So the other great thing about investing in JP Morgan right now is that over the next few months, you're going to see that this company is allowed to start doing massive share buybacks. They've already approved a really big share buyback. I believe it's about 10% of the entire company, if I'm not mistaken. And they're also going to be able to increase the dividends that they're going to be able to pay out. This is an important thing because over the past year, they haven't been able to increase dividends at all because of the Federal Reserve, worried about whether or not these banks have enough money. Clearly they do. So in the coming months, they're going to be able to increase that dividend. I would like to see it go back up towards around a 3% yield. It pays about $135 for me right now with 150 shares. The second stock that I'm talking about here is going to be the second largest position, and that is O Stock, okay, Realty Income Corporation. When it comes to these trusts, essentially it was set up with, investors, and, they're putting money into it, and sometimes they issue shares. So the way it works is that they take that money and then they go finance some deals to buy properties by the hundreds and thousands. This company owns over 6,000 different properties. They're also expanding into the United Kingdom as well. And they have a diversified portfolio, which is largely business to business, right? They're renting out to the likes of Walmart, to 7-Eleven. Those are some of the top retailers in the entire world. Look at the top 10 here. You can see that there are some quite essential businesses, but there are also some players out there like the theaters and the fitness centers that have not been doing well in 2020, obviously, and even in the early parts here of 2021, but that is going to start to come back. I think that their tenants are going to be able to pay their rent. We've already seen that those tenants that were not able to pay are consistently starting to get back into the game here, and their collection rates have been going higher throughout this pandemic period. So I think that O Stock is generally a very safe stock, despite the massive crisis that we've had. The stock has held up, the business has held up, and they're still focused on where they can grow. This company still has consistent revenue growth, around double digit 10%, and with that expansion right into other regions. I think that this is a really great company. Looking at the history of the stock price as well, and the historical data as far as share price returns plus dividend returns, you're getting about 15% annually. You look at the history of the stock chart, and it's overall done nothing but go up. The dips have been nothing but good buying opportunities. And over the past year, I've really built up this position and taken it more seriously. I have about $10,000 in it now, and it returns about $35 a month. Okay, the third stock on this list is one that I am excited about. It was in my 6 stocks I'm buying video just recently, and that is VALE stock. This is a South American miner with the #1 world market share when it comes to iron ore production, and iron ore is used to make steel. And we know construction and infrastructure is going crazy right now. Globally, there's so much money out there that is going towards new projects and updating things and building on machinery, that steel is definitely going to be in high demand. And we already see with inflation, the prices have been going crazy. So VALE is going to be able to charge more money and profit more on the production. So VALE stock, VALE, offers around a 6% dividend yield that is paid semi-annually. So the way it works is a little bit different than what we usually find in dividend stocks. They structure it as the first payment you get in the first half of the year is going to be based on their net income for that year. A certain minimum amount, it's kind of variable, right? And the second dividend payment is going to be based off of how well they do for net income in the second half of the year. So 6% is a pretty strong yield when it comes to large companies. This is an over $100 billion company. It has a lot of trends going for it. So I can only see that net income rising. I wouldn't be surprised if they can maintain this dividend, or they might decide to actually increase it depending on how well that net income goes, right? So for me, VALE stock is definitely one that I am buying and may continue to buy over the next few weeks and months ahead. Now, unfortunately, this company did have a troubled few years in the past because of some mining accidents, and they have to pay over $7 billion in reparations. But this company does have a really strong balance sheet, and they have a lot of income. Just in the past year, they did almost $5 billion in net income. So I do believe that things are turning for the better, and this stock still is pretty undervalued, potentially because of its past. Hey, they changed the CEO since those incidents, the latest one, I believe, in 2019. They changed the CEO. They've done a complete change of the executive board of directors. They've laid out, these long-term 5-10 year plans to really reform the business culturally, but also when it comes to ESG, when it comes to de-risking their portfolio of mining setups. I do believe that this company has made the changes that warrant a better stock price. And we've already started to see a re-rating of this, where just several months ago, this stock was around $8, $9, $10, and now it's trading around $19. I do believe there's still more upside because You have a valuation that is very low, a PE ratio of 20, but a forward PE ratio that sits around 6. And they're also planning to increase their mining capacity once again by 33% to their original production capacity. They were limited for the past year or two because of those previous incidents. So with that production capacity coming on board, they're going to be able to sell even more. And we know with that demand, they are going to be able to sell that. And not to mention, they also have mining as far as other elements out there like nickel, which is used in a lot of EV components. And we know the EV boom is going on, and it's going to be going on for the next 5-10 years. So that is something that is also very attractive about this business. And the last stock we're talking about here, stock number 4, is going to be DOW Stock, DOW Kapow. So DOW is a basic materials company that does packaging and specialty plastics, industrial intermediates, and performance materials and coatings. For a large part, their business is consumer oriented, so the products that are eventually made are things like paints, things like consumer packaging. These are some things that have seen some tailwinds over the past year because of the pandemic, like stay at home, DIY remodeling, and more snacking. But they do have an automotive side of their business as well, which has been lagging but should come back. Their main focus is on paying the dividends, so they do pay a 4.3% dividend yield. That is pretty strong. If you grabbed the stock last year in 2020, you would have made a killing because at one point this was like $30 per share and that was like 8% dividend yield. At the low, it might have been 9 or 10%, which, wow, right? That would have been great. But, here today, this is still a pretty strong yield. And this is a company that is at a low valuation. So when you look at the forward PE, it's actually under 20. So forward PE in the teens, that's really great. It's low compared to the rest of the material space and compared to the rest of the stock market. And what I really like about this company also, even though it's, a large part of their business is involving plastics and, that's not a good thing for the environment long term, they do have an ESG plan. They're working on creating new biodegradable types of packaging material. They're also working on recycling initiatives, using clean energy within their operations. So that is something that I do appreciate about this company. And lastly, what I really like is that over the past year, they have paid off a lot of debt. Almost $2.5 to $3 billion in debt that they've paid off. And the less debt that the company has, the more those profits are just gonna go straight to net income and gonna go straight to shareholders. And I've definitely seen a lot of stocks that pay high dividends, but the company also has a ton of debt. And when a recession hits, like last year, we saw a lot of these companies stop paying their dividends. Some of them went out of business even, right? So you're not going to see that with this particular company. So overall, if we look at my dividend stocks kind of as a portfolio here, it is about $45,000 in value at the moment. I collect about $135 per quarter from JP Morgan Chase. I collect about $35 a month from Realty Income Corporation, DOW Stock. There is an annual dividend of about 6% from VALE, which works out to about over $400 on an annual basis. And with DOW Inc., you get about $70 per quarter, so that is $280 per year. And put that all together, and you get approximately $1,700 in dividends. Now, if you have a really large portfolio and you're investing, instead of $45,000, you're investing $450,000, then you're getting a pretty decent return for your money passively without doing work for yourself, right? If you have $1 million in a dividend account, then you'll be getting $40,000 per year. And the thing with dividends, right, is that over time, the expectation is that these companies will increase their dividends $1, $1.10, $1.20. Eventually, at some point, given enough time throughout decades, if you're planning to hold long term, it could hit $2. And so, eventually these dividends could double. So your percentage getting into these dividends goes from suddenly 4% yield, you could be getting 8% yield or 10% yield over a long period of time. And the more money you have going into these stocks, the more you're going to reap after your investment. With that being said, guys, I hope you enjoyed this video, and let me know in the comments down below if you are investing in any dividend stocks. I'd love to hear your thoughts. And until next time, my friends, stay well and invest responsibly.